Welcome back. In this video, we are going to look at how an IPO may be priced. Now, the details of how IPOs are priced might vary slightly from country to country. However, broadly we can say that there are two ways in which an IPO may be priced. These are the fixed price issue or the Dutch auction. Let's look at them one by one. Starting with the fixed price issue. In a fixed price issue, the company issuing the security decides the issue price by consulting a lead manager. A lead manager may be an investment banking firm. This lead manager justifies the price based on the expected performance of the company and also on the basis of price of shares of comparable companies in the market. The issuing company then may inform the public about the issue price along with all the relevant information related to the company's past financial performance. The investors can then take a decision on whether they would like to invest at the issue price or not. The other way the pricing of an IPO is decided is through the book-built issue or the Dutch auction. In case of the Dutch auction, the price of the issue is decided by an auction. The company, in consultation with the lead manager, specifies a floor price, which is the minimum bid price they are willing to accept for their security. Alternatively, the issuer may specify a price band, that is a minimum and maximum price within which the investors can bid. When the issue opens, the investors place a bid price and a corresponding bid quantity. This bid price is required to be above the floor price or within the price band. Once all the bids have been received, the issuer of the security, in consultation with his lead manager, decides on the cut-off price for the security. All bidders who have bid above this cut-off price get an allotment of shares at the cut-off price. Let's understand this with an example. Let's say a company A wants to issue 1000 shares through a book-built offer. Let's say the company has decided on a price band of 120 to 144. Let's assume that the company has received all these bids. The company would start by sorting the bids from highest to lowest. It would start by allocating shares to the highest bidder first and then progressively moves down until all the shares that need to be sold are allocated. So in this example, first the company allots 200 shares to the bidder with the bid price of 144. Since the company intends to sell 1000 shares, it still has 800 shares left. Hence, it will look at the next bid at 140 and allot 300 shares. After both these allocations, 500 shares are still left. So the company will look at the next bid. Here it will allot another 500 shares. So now the company has allotted all of its 1000 shares. Since 135 is the lowest bid price at which shares were allotted, this becomes the cutoff price. All investors who bid at this price or higher than this price are eligible for allotment. For the benefit of the investors, the company may also choose to decide the cutoff price at a lower price than the price at which the issue is subscribed. Sometimes companies also have a clause for retail investors to be allotted shares at a discounted price. With this, we have covered how pricing works in the primary market and the secondary market. In the next video, we are going to understand stock exchanges.